Cathie Wood isn't merely forecasting a downturn, she's signaling an economic catastrophe unprecedented in scale. Why is her warning so critical? Don't forget to hit that like button and subscribe to stay updated with our latest content.
The investment process is centered around research and original research. I'll start with Too Simple. We sold Too Simple after the CEO, who was the technology visionary, left. And so Grizzly got that right, I don't think for the right reasons, although we were in the teeth of a massive bear market as well. If that CEO had not left, I don't think we would have sold that stock. In the case of Archer, we have a high degree of confidence in Archer. One thing to understand about ARK is we are the closest. ARK is the closest you'll find to a venture capital company in the public equity markets. And we tread where others in the traditional asset management world will not go, at least on the public side, when we see a real opportunity. As we were doing our work on autonomous vehicles, we concluded that the cost is going to drop so much that roads are going to become very congested in the future, much more congested, if you can imagine, New York City. And so we then started doing work about transportation in the skies. Is it possible? Yes, it is possible. The FAA is the gating factor from a regulatory point of view. There are two companies the FAA is working very closely with, and I think because of successes elsewhere in the world, other companies are having success where regulators have not been as strict. I think there's been a little more pressure on the FAA to pay close attention here. And the two are Archer and Joby. Our confidence went up when Boeing, which was suing it for patent infringement, settled the case and actually took an ownership position in Archer, as has Stellantis and United Airlines. So three very deep-pocketed partners who are also trying to figure out the future of transportation. And we know that they're on their way, both Joby and Archer, to FAA certification. Seems like the process is in motion, and we haven't had a hiccup. And it has an MOU with Abu Dhabi to launch an air taxi service in 26. And pending regulation, it has an MOU with Interglobe to launch an air taxi service in India. Both of those have been much better from a regulatory point of view. Attention to regulatory arbitrage. We've seen innovation move abroad to other countries, even Amazon. The FAA wouldn't let Amazon fly its drones, ninth generation, nearly 10 years ago, on its own property outside. So it went to India and elsewhere. I think the pressure's on the FAA now. And I also think that the bear market of 21 and 22 eliminated a lot of other competition that was brewing. Just the funding markets were closed. And so I think this market is much more that both Joby and Archer are going to have much more share than otherwise would have been the case. So we're pretty excited about the possibilities here.
Let's comment on what she said. The statistics unveil a distressing scenario, marking a pivotal moment in our economic landscape. Originally, in 2020, we observed the M2 money supply growth reach a staggering 27%, a level of fiscal expansion deemed unsustainable. Fast forward, and we're witnessing this growth rate nosedive, potentially falling below 3%. This stark decline isn't merely a cautionary signal, it's an urgent alarm, indicating we're on the cusp of an economic contraction far surpassing any previous recessions. So, what's on the horizon for us? Are we merely retracing historical patterns? Or are we on the verge of an unparalleled economic transformation? We're set to delve into Cathie Wood's profound caution, dissecting the numbers and their implications for investors, policymakers, and the everyday person. In the forthcoming days, we'll first explore the critical warning signs identified by Cathie Wood. The term recession might be familiar, but Cathie is pointing towards a phenomenon potentially far more daunting. Through her analytical lens, Cathie has unearthed concerning trends, particularly with regards to square meter growth, a measure of the money supply that reflects the total cash available within the economy. This metric, which surged by 27% in 2020 amidst governmental efforts to stabilize the economy during the pandemic, has dramatically slowed, now teetering on the edge of possibly dropping below 3%. Such a precipitous decline signals far-reaching consequences, impacting the availability of capital for spending and investment, vital cogs in the machinery of economic vitality. But the concern extends beyond mere numbers. The behavioral shift amongst businesses and individuals, who are increasingly adopting a more conservative approach to spending, underscores the gravity of the situation. The collective tightening of belts hints at a broader apprehension, an intuitive response to the foreboding economic indicators. As we proceed, we'll dissect these dynamics further, unraveling the complex web of factors at play and their potential ramifications for our economic future.
And public pension funds. And why is this? Because they're trying to figure out if this truly is a new asset class. And if it is, they must have a point of view. As a fiduciary, if there's a new asset class, which is uncorrelated or shows very low correlation in terms of returns relative to other asset classes, then what an asset allocator does is it will take a position to increase returns per unit of risk. That's what happens with low correlation of returns. So definitely, now, are they moving whole hog? Not yet. And nor are the big wirehouses like the Morgan Stanleys and UBS's, Wells Fargo, Merrill Lynch, B of A. They're all waiting to see who are the winners in terms of the ETFs, because they do not want to commit to an ETF that will close down. And
makes sense.
And right. So, and they're going to give it, from what we're hearing, 3 to 6 to 9 months. So everything, the net inflows that we've seen, and are away from those two spaces, really. It's part of it is our client base switching from GBTC into, and other client bases, into the ETFs, which are much lower fee.
We're seeing a shift towards saving more just in case things take a turn for the worse. This change in sentiment is significant because it reflects a wavering confidence in the economy. When individuals and businesses start to hold back on spending out of caution, it can exacerbate the economic downturn, a self-fulfilling prophecy of sorts. Cathie also highlighted an anomaly in the money supply. Typically, you'd expect it to steadily increase over time. However, for the first time in a while, we're witnessing a contraction from one month to the next. This deviation from the norm isn't promising for economic growth. Then there's the Federal Reserve, tasked with managing US monetary policy. Cathie believes they may be making a critical error in their approach to handling inflation by tightening the money supply and raising interest rates. It's akin to slamming on the brakes of a car too hard, potentially causing a crash. She's concerned that this path could lead to unnecessary economic hardship. Reflecting on history, we've encountered similar challenges before. In the 20th century, the Fed grappled with inflation, but today's economic landscape is different, more fragile and nuanced. What worked in the past may not be applicable now, and the consequences could be dire. In essence, Cathie Wood's message is clear. We're facing more than just a typical downturn. We're not just facing your typical recession, there's a potential for something much larger, something that could deeply shake the foundations of our economy. Given the current trajectory of tightening finances and growing caution among individuals and businesses, it's a warning we all need to heed. Now, let's delve into the role of technology in all of this. You might be wondering, what does technology have to do with economic downturns and financial matters? Well, as it turns out, quite a lot. Cathie Wood and her team at ARK Invest are champions of how innovation and technology are shaping our future. While technology is undeniably booming and revolutionizing various industries, it's also disrupting traditional economic models. Consider the growth of the tech industry in recent years, double-digit growth rates in many areas, which are not just impressive but transformative. However, with significant growth comes substantial changes, and not all sectors or workers can keep up. The investment in tech is staggering, with billions poured into startups and innovations. This influx of capital propels us forward but also disrupts traditional businesses and jobs, creating a double-edged sword scenario. Additionally, digital currencies and blockchain technology are making waves, potentially challenging traditional banking systems and government monetary policies. But it's not all negative. With challenges come opportunities. The tech revolution is opening up new markets, creating jobs in unprecedented areas, and driving efficiency and sustainability. However, it's crucial to handle this change wisely, ensuring that technology benefits our economies while safeguarding those who may be left behind. To truly grasp the current landscape, we need to revisit the economically tumultuous 1970s. This period was marked by significant challenges, providing valuable insights into our present situation. In the aftermath of the Vietnam War and ambitious social programs initiated under the Great Society banner, there ensued a spree of spending akin to an unlimited budget. However, this resulted in severe financial repercussions, including soaring inflation and an unstable economy. The era was characterized by significant fiscal and monetary measures aimed at maintaining stability, albeit often exacerbating the situation rather than alleviating it. Today, the scenario is markedly different, as pointed out by Cathie Wood. The current slowdown in the movement of money within the economy is unprecedented. After years of injecting funds into the system to sustain operations, it seems as though someone has abruptly applied the brakes. This simultaneous halt in both monetary and fiscal policies is highly unusual. Comparisons with the tumultuous economic climate of the 1970s are striking, leading one to speculate that we might be bracing for an even more severe crisis. Reflecting on history, while the chaos of the 1970s was intense, the sense of urgency and action to confront the challenges head-on was palpable. This historical context is crucial as it illustrates that while history may not repeat itself identically, it often bears resemblances. Now, let's delve into the topic of inflation, a pressing concern in recent times. Cathie Wood has been vocal about this issue, drawing parallels with the efforts of Chairman Volcker in the late 20th century to rein in inflation. However, she emphasizes that the circumstances today are vastly different, with our interconnected global economy and complex challenges. Combating inflation is akin to solving a puzzle with constantly shifting pieces. There's a concern that policymakers may be overly reliant on past strategies, potentially overlooking the unique dynamics of the present. However, navigating the current inflation battle is far from straightforward. It's entangled with various global issues, ranging from supply chain disruptions to shifts in energy consumption, and even the economic ramifications of diseases like COVID-19. When Cathie addresses inflation, she underscores the necessity of abandoning conventional solutions for novel challenges. We must adopt a fresh perspective and comprehend that the economic hurdles we confront demand innovative ideas and approaches. The gravity of this situation cannot be overstated, as missteps could significantly exacerbate hardships, impacting everything from grocery prices to job security. Now, let's delve into the crucial aspect of preparedness for an impending economic upheaval that many have yet to anticipate. Cathie Wood has been sounding the alarm, warning us of turbulent waters ahead. This isn't merely a passing storm, but rather a monumental event, akin to an economic apocalypse looming on the horizon. So, what's the game plan? How do we brace ourselves for an unforeseen challenge? Firstly, staying well-informed is paramount. It's not just about monitoring the fluctuations of the stock market, it's about deciphering the intricate economic signals that reveal the true state of affairs. While it may seem daunting amidst the sea of terminology and numbers, it's essential to maintain a grasp of the bigger picture. Furthermore, exercising prudence with our finances is imperative during these times. It's not a time for reckless spending or risky ventures. Caution is key. Diversifying investments and building up emergency savings are prudent steps to weather the storm. Additionally, prioritizing long-term financial health is crucial. It's easy to become ensnared in the minutiae of daily affairs or succumb to panic amidst adversity. However, making decisions with an eye toward the future, such as saving for retirement or investing in assets with long-term growth potential, is pivotal in navigating the uncertainties ahead. In conclusion, preparing for this looming economic challenge necessitates astuteness, vigilance, and prudent decision-making. It's about safeguarding our interests and securing our future, irrespective of the adversities we may face. What are your insights on Cathie's prognostications? Do you believe we're hurtling towards an economic apocalypse, or do you see avenues to mitigate its impact? Share your thoughts in the comments below.